Welcome to our channel. In this video, we will be looking into the best chart patterns which will help you understand how to predict the direction of market. These chart patterns can help you predict stocks, forex pairs, and crypto markets. Because price actions stay relatively same across these, there are three types of chart patterns that you must understand: reversal patterns, continuation patterns, neutral patterns. What does continuation pattern mean? It means that trend is likely to continue in the same direction once the pattern is complete. A pattern is considered complete when the pattern is formed or can be drawn and then breaks out of that pattern, potentially continuing on with the former trend. A reversal pattern is any time a trend reversal pattern of an asset, from a rising market to a falling market or vice versa. We can use this pattern to predict the market trend. Neutral, also known as bilateral chart patterns, are a bit tricky because these signal that price can move in either direction. In this video, I will be giving you the best 10 chart patterns that you can start using and make profits. So make sure you don't skip any part of this video. A chart pattern is a shape that is formed on price chart that gives us idea where the price might move. These movements of prices are taken from past data. Pattern number 1. Ascending triangle. An ascending triangle is a bullish chart pattern that is characterized by a series of higher lows and a flat resistance level. It is typically seen as a sign that the price of a security is likely to rise. The pattern is formed when the price is restricted by a horizontal resistance level and a rising trendline created by a series of higher lows. A breakout from the pattern usually happens on high volume and can result in a significant price move. To get an entry confirmation, you need to learn candlestick patterns. I highly recommend you all to watch these videos. If you spot an ascending triangle in live market, then must wait for your confirmation at this level. Pattern number 2. Descending triangle. A descending triangle is a bearish chart pattern that may indicate a downward price movement. It is formed by a horizontal resistance level and a downward sloping trendline connecting a series of lower highs. This pattern is identified by its shape and the fact that the price consistently fails to break through the resistance level. It is important to consider the time frame and other factors such as volume and market conditions when trading this pattern. If you spot this pattern, then take candlestick confirmation over this point. Pattern number 3. Symmetrical triangle. A symmetrical triangle is a chart pattern characterized by two converging trend lines connecting a series of successively lower peaks and higher troughs. This pattern typically forms during a period of consolidation, during which the price of an asset is coiling and getting ready to make a move. The symmetrical triangle is considered a neutral pattern, meaning that it can resolve itself in either an uptrend or a downtrend. Traders often look for a breakout from the triangle pattern as a potential trading opportunity. A breakout occurs when the price of the asset moves outside of the converging trend lines, and it can be a sign that the asset is getting ready to make a significant move in a particular direction. However, it is important to note that triangle patterns can be prone to false breaks, so traders should be careful to confirm the breakout before entering a trade. Pattern number 4. Double top. The double top pattern is a bearish technical chart pattern that is created when the price of an asset hits a high, retraces, and then fails to break through that high again. It is called a double top because it looks like the letter M on a chart, with two peaks of approximately the same height. The double top pattern is considered a bearish reversal pattern, which means that it is often seen as a signal that the asset's price is likely to fall in the future. This pattern can occur on any time frame, but it is most commonly seen on daily or weekly charts. Entry point for this pattern is here. Pattern number 5. Double bottom. The double bottom pattern is a reversal chart pattern that appears on a chart as two distinct, consecutive troughs that are roughly equal in price and size. It is typically considered a bullish pattern that signals the end of a downtrend and the beginning of an uptrend. The double bottom pattern is formed when a stock or other asset falls to a support level, bounces back up, and then falls back down to the same support level again, before finally bouncing back up. The pattern is completed when the asset's price breaks above a resistance level, which is often identified by a horizontal line drawn across the tops of the two bottoms. The double bottom pattern is considered a reliable indicator of a potential uptrend and is often used by traders to help make buy decisions. This is the entry point for this pattern. Pattern number 6. Head and shoulders. A head and shoulders pattern is a chart formation that appears as a series of peaks and troughs resembling a head and shoulders. It is considered a bearish reversal pattern, which suggests that the price of a security will trend downward after the pattern is completed. There are 3 parts to a head and shoulders pattern. Number 1, the left shoulder. This is the first peak, which forms the leftmost part of the pattern. Number 2, the head. This is the highest peak in the pattern, which is higher than the left shoulder and the right shoulder. Number 3, the right shoulder. This is the third peak, which forms the rightmost part of the pattern. It is typically lower than the head, but still higher than the left shoulder. The head and shoulders pattern is completed when the price falls below the neckline, which is a horizontal line drawn across the lows of the left shoulder, head, and right shoulder. This breakout below the neckline is a bearish sign, indicating that the price may continue to fall. Pattern number 7. Inverted head and shoulders. Inverted head and shoulders is a bullish chart pattern. It is formed by the price creating a peak head, falling back to form shoulders, and then rising again inverted head. This pattern indicates that the asset is likely to rise in price and can be used as a buy signal by traders. Pattern number 8. Bullish and bearish flag patterns. First, we will see bullish flag. A bullish flag pattern is a chart pattern that occurs in an uptrend and is characterized by a period of consolidation or correction, followed by a breakout to the upside. The pattern is formed by 2 lines that slope down and away from each other, creating a channel or flag shape. The breakout from the flag pattern is considered a bullish signal, indicating that the uptrend is likely to continue. The pattern is often used by traders as an indication to buy or hold onto a long position in an asset. Now, we will see bearish flag. A bearish flag is a chart pattern characterized by a downward sloping channel formed by a pair of trend lines. The pattern is typically considered to be a bearish reversal pattern, as it is often seen as a pause in an uptrend that indicates a potential trend reversal to the downside. The pattern is formed when the price of an asset falls sharply and then consolidates in a downward sloping channel. The downward trend line of the channel is formed by connecting the highs of the price action, while the lower trend line is formed by connecting the lows. Once the price breaks out of the channel to the downside, it is thought to confirm the bearish trend reversal. It is important to note that, like all chart patterns, the bearish flag pattern is not a guarantee of a trend reversal, but rather a potential indication that one may be imminent. Pattern number 9. Falling wedge. A falling wedge pattern is a chart pattern that occurs in the context of an uptrend and is considered a bullish pattern. It is characterized by a series of lower highs and lower lows, with the trend line connecting the lows sloping down at a sharper angle than the trend line connecting the highs. This pattern can be seen in the price action of a stock, index, or other financial instrument. The falling wedge pattern is thought to be a bullish pattern because it indicates that the selling pressure is decreasing and the price is likely to break out to the upside when the price breaks out above the upper trend line of the falling wedge. It is often considered a buy signal. However, it is important to confirm the breakout with other technical indicators and to use appropriate risk management techniques when trading based on this pattern. Pattern number 10. Rising wedge. A rising wedge pattern is a chart pattern that occurs in the context of a downtrend and is considered a bearish pattern. It is characterized by a series of higher lows and higher highs, with the trend line connecting the lows sloping up at a sharper angle than the trend line connecting the highs. The rising wedge pattern is thought to be a bearish pattern because it indicates that the buying pressure is decreasing, and the price is likely to break down to the downside when the price breaks down below the lower trendline of the rising wedge. It is often considered a sell signal. However, it is important to confirm the breakdown with other technical indicators and to use appropriate risk management techniques when trading based on this pattern. If you need trading cheat sheets, please leave your emails. For confirmation candlestick patterns, watch these videos.